Hello, everybody. Ed Yardeni here. It's October 28th. Time flies when you're having fun. When the market's going up like this, it's certainly fun. It's been remarkably good September and October for the market. Usually markets have fears about those 2 months, and they have been fearless months so far. Market's doing extremely well, even in the face of all sorts of things to worry about. But I guess the wall of worries has been working here in terms of the market continuing to perform well. But Eric, thanks for joining me. I guess we both got the corporate memo about wearing sweaters today. So yeah, you got a nice sweater there. I think mine's pretty good looking. We got great weather here. It's finally getting seasonal, getting a little chillier, but it's been sunny and no rain for well over a month. And wouldn't you know it, the sprinkler guy's coming to shut it all down today. So hopefully it'll start chilling a little bit. But maybe we won't have a winter again this year. We didn't have much last year. What's new in California, in Malibu there?
Not much, 70
You're not
degrees.
in Malibu, right? You're in Santa
No,
Monica.
yeah, Santa Monica.
You got to work for us a little bit more before you can upscale to
Yeah,
Malibu.
yeah, I'm a little priced out of Malibu at the moment, but leaves don't change here. Palm trees are still green. It's all good.
Good, good. All right. Well, lots of things to talk about. Certainly, the markets have been doing well. I guess one of the issues we've been dealing with is earnings and valuation. Recently, we've been kind of doing some counterpoints to Goldman's thesis that the better things are now, the worse they're going to get for us in terms of returns in the stock market. Goldman acknowledges and that the total return of the S&P 500 has been 13% over the past decade, that the longer term trend has been 11% for total return. And yet they're predicting that over the next 10 years, it's going to punk out on us and be only 3%. What's the reasoning there, Eric?
Yeah, I mean, the primary thing they're citing is valuation, right? And when you start at a high valuation, that depresses your forward returns is something, I mean, we've been hearing for years, frankly. But I think you made a really good point to me. And valuation really reflects how quickly investors expect earnings to grow. And when you have a more, tech dominated, and a lot of these tech companies are pretty high quality. When you have very fast earnings growth from a lot of these mega cap companies, it makes sense that valuations are higher. And I think corporate profit margins support that story as well.
Yeah, well, it's not just how fast earnings are growing, but how long they're going to grow that fast. I guess my observation over the years is that yeah, I guess I was given an incentive to think more about valuation just recently when one of our accounts said that he thought that valuation was mostly driven by interest rates,
Mm-hmm.
which then are mostly driven by inflation rates. And I thought about that a bit. Then, what comes to mind is that when people are buying stocks, they're willing to pay a higher multiple for that stock, not only because its earnings are growing faster than most, let's say the average stock earnings are growing, but also because there's sort of a macroeconomic uh, forecast built into buying a stock with fast growth is that it's going to continue. It's not going to be just 6 months, 12 months, but it might be a few years at least. So the macroeconomic variable of how long an economy is going to grow and stay out of recession is relevant. And here, Eric, we just have a horrible recession in 2022 and 2023, and so far in 2024, it was certainly billed as a significant recession, but it turned out to be a non-event. It wasn't a hard landing. It wasn't even a soft landing. It's been a no landing. So maybe we should get credit for that as Well, that was sort of the recession, or at least that was the recession mentality, and the stock market certainly took it on the chin there in 2022. And it wasn't that long. It was a 25% uh, drop, which isn't that much different than a correction. And it certainly didn't last very long. It lasted from January to October. And here we are at record highs in the market. So I think to the extent that the economy survived all this recession talk, more importantly, to the extent that it survived the Fed tightening monetary policy so significantly, should we conclude from that that maybe the economy is resilient enough so we don't have to worry about a recession through the end of the decade? And I'm not saying we'll never have a recession again, and I'm not saying that we can't have a recession between now and the end of the decade. But what matters is what people think, what they believe, and if the experience of the past 2.5 years has sort of hardened them uh, to, uh, to the concerns about a recession as being imminent, then they might very well be willing to pay a higher PE, and that certainly applies to the Magnificent Seven. You're working on some stuff with regards to the hard versus soft data. We've been very happy to see that the hard data supported our story, but we keep getting pushback from people who say, "Well, what about the beige book? What about
Yeah.
the PMIs?" Any preliminary thoughts on what you're coming up with?
Yeah, I mean, I think starting with the beige book, we've seen a number of competitors, commentators saying or pulling out kind of bearish anecdotes from the beige book, which is of course the Fed gets all their district banks to speak to business leaders in the region, economists, etc. But you can find an equal number of bullish anecdotes in there as well. Some industries and some regions will say hiring is slowing. We don't want to hire new workers. We're not seeing expansion. And another district and another industry will say, hey, lending is pretty available. We're not laying off workers. And you can either use that data to confirm whatever bias or narrative you have already, or you can try and pick out, where there might be some contrarian stuff, and you can go explore that. But it really points to a number of things have been offside. SLOOS is the survey of bank lending officers. There's been no slowdown. There's been no fall down or decline in bank lending. It's still growing. The ISM has been downbeat. I mean, that's actually been a pretty good indicator of where the goods producing economy's been. But soft data is just not as good post
Yeah.
pandemic. So
Well, even the ISM on the manufacturing side has been getting it right. But what's interesting is that when you look at real GDP and real GDP, you can get data on goods versus services. There's been no recession whatsoever in the goods real GDP on a year-over-year basis. No negative numbers on a year-over-year comparisons, and they've been kind of hovering around 2%, which is pretty good, all things considered. So when you look at the sort of the bigger picture, you kind of wonder whether the ISM and even the industrial production measures are picking everything up that's in fact in the goods sector of the economy. Meanwhile, the services economy is still doing well, and I think more and more of the Heartlanders, I'm seeing that's, but there's more recognition that the reason the consumer is staying strong is because of people like me, the baby boomers, but not really like me because I'm working, but a lot of the baby boomers that are retiring and are still spending. But it's there's a lot of moving parts in the economy, and as you said, it's easy to kind of cherry pick the ones that are looking bad if you're looking for trouble. Uh, and again, because there are so many perma bears out there doing such great work about what could go wrong, they save us a lot of time. So we just read them and we learn about all the things that can go wrong. And then when we try to balance that off, we rarely find things to add to their list of things that could go wrong, and instead find lots of things that could go right. Over the weekend, Israel took out some military facilities and maybe more than that. The Israelis want to make light of it. So, it was a limited attack, and the Iranians want to make light of it. I think both sides want to give it the tit for tat retaliation game they've been playing. I think they want to give it a rest here for a little while. The Israelis may want to see what happens with the election here. Maybe they'll go back there if Trump's elected. Maybe they won't go back there if Harris is elected. I mean, anything is possible. And the Israelis have demonstrated that they view this as an existential war with Iran, and no matter what others think, they're going to pursue the goal of achieving some sort of stability in the Middle East for themselves. So the markets took that pretty well last night. We pointed out uh, in our uh, in our briefing that the Israel that because of the situation being such that they're not attacking the oil facilities, and the price of oil dropped like 6% through this morning. And the amazing thing, Eric, is the bond market. Tell us, share with us some of the things we've been talking about with regards to the bond market. It wasn't that long ago that the bond yield was 3.65%. The Fed cut the Fed funds rate by 50 basis points, and everybody figured, hooray, the bond yield is going to keep falling, but not us.
Yeah, it was interesting that even as oil was falling, bond yields were rising 4 to 5 basis points overnight. And a lot of that was led by real rates. Break evens were kind of unchanged. But all else equal, if oil falls 5%, you'd expect break evens to narrow because there's a very tight correlation. So I think the market is pricing in, that there's been stronger than expected economic data. We had some positive revisions. And the fact that the Fed cut 50 basis points into that and had some very dovish guidance just raises the risk that, there will be more inflation or even higher growth longer term. You just have higher nominal growth. And that's, putting some upward lift on the long end.
It is fascinating, though, because I think we all agree that energy is probably one of the most important components of the inflation story.
Mm-hmm.
And with energy prices falling here, I mean, we're going to get some pretty good CPI and PCED inflation rates overall. We've been pointing out that there's some sticky stuff in there that still remains stuck. Um, but if the overall inflation rate continues to moderate, the Fed can continue to basically act as though their mission has been accomplished, and yet the bond market doesn't want to give them what they want. I think Fed officials say, "Hey, look, we've done such a good job of bringing inflation down. Let's bring interest rates down." So, I mean, we're still, I guess, in the none and done camp for the rest of the year, and then we'll have to address what happens next year. But the bond market certainly is acting as though the economy is stronger than was expected. That maybe some of the stickier parts of inflation are still a concern, and oil prices can go down, they can go up. So maybe they're focusing more on the core inflation rate, particularly in the services area. And then they may very well be dealing with the deficit issue again. Tell us what we're discussing here in terms of the political outcomes and the bond market.
Yeah, I think it seems like both sides of the aisle are committed to a wider fiscal deficit, whether that's via tax cuts, so lower incomes, or just more spending. In terms of the Democrats, there's a plan to use tariffs to replace income taxes in a variety of ways. There's not a lot of literature supporting that, at least not enough in terms of a full replacement. So especially if we get a sweep and either party can, check mark and pass a lot of their proposed legislation, it's very likely that the already wide deficits continue to widen. So the bond market might be sniffing that out, regardless of which party wins.
Yeah.
It's
Well,
more spending.
yeah, there seems to be a mild consensus, not a soft consensus, not a hard consensus, that if Trump wins, that it would be a more likely red sweep than
Mm-hmm.
if Harris wins. That she may not get both houses of Congress, maybe not either one of them. So that's what I'm hearing, and that's what the commentators seem to be saying. And at the same time, there's sort of chatter that a Trump sweep or Trump win, forget about the sweep, but just a Trump win is more bullish for the stock market than a Harris win. But I mean, the polls have been showing some upward momentum for Trump and not so much for Harris. And that being the case, and the market's up, obviously the commentators are going to look at the correlation and say maybe it's because the market's discounting Trump. But we're kind of thinking that, well, that's interesting, because if the bond market, on the other hand, views Trump as maybe more inflationary because of tariffs, though that may just be a negotiating position,
Hmm.
um, or just I think there have been some projections that his deficits would be bigger than Harris's deficits, though all these deficits are ugly. So I think we have to watch the bond market reaction in terms of how the stock market goes. But meanwhile, the stock market's tuning it all out. Nasdaq's a record high. Earnings are doing well, and I think part of that is in fact because the Magnificent Seven story is still alive and well, and it's probably spreading to the 493. But I think we're having some second thoughts about whether the Russell 2000 benefits as much, because I think everybody believes it, and rightly so, that the Russell 2000 needs interest rates to come down, and if they don't come down, then that benefits some of the bigger market caps. Let's go to the to look at the charts. Okay, so this I think is sort of a useful chart to look at when we're looking at the Goldman thesis of 3% annualized total return. This is the total return here, and you can see that since the 1930s, this thing has been on a pretty good track, generally 11%. So it's got the dividends in there. And then this is just the S&P index all by itself. And it too, at least recently, in recent years, has been on a 6 to 7% track. And I mean, Goldman has a point. If the valuation multiple is historical highs or relatively high at 22 for the S&P 500, and it gets cut in half, which would be a reasonable possibility in, a cyclical downturn, for example. Could it go from 22 to 11? It could. Then in that case, then presumably if the earnings trend remains intact, though I guess if you go from 22 to 11 on the PE, something bad's happened to the economy. But the valuation story seems to be, as you said, Eric, the heart of the issue. So let's have a look at some of the valuation IDs here. Earnings, this is reported earnings going all the way back to the 30s. They tend to be volatile along with the economy, but the growth rate tends to be 6%, which is consistent with what the S&P 500 delivers on a fairly consistent basis. Then the total return, of course, includes dividends, and this shows you what happens if you buy a portfolio at different times, and how dividends compound over that kind of period. So dividend return is a very important component, obviously, of those kind of returns. I have to believe the Goldman people accounted for that, but again, S&P 500 index returns 6% on average per year, and the total return is 11%. So what happens to that 4%? Does it just disappear? I haven't quite figured out that idea, but that notion. But meanwhile, valuation, the trailing PE is not that high, but it's somewhat elevated. It's the forward that's elevated. As you can see over here, the forward PE is around 22. It's coming out strong relative to 25. And I guess you can justify this with the Fed now wanting to be less restrictive with inflation coming down. But our thinking is that those that kind of outlook for inflation and interest rates increases the odds that the current expansion will continue. And if that's the case, then investors should be willing to pay a higher PE overall for the market and an even higher PE for companies that are growing faster than average. So here again is the PE ratio on a forward basis. This is another cut of the idea forward PE versus the bond yield. And I actually, I don't know if you know this, Eric, but I coined the phrase of Fed stock valuation model back in the late 1990s. And this is what it looks like here. This is taking the reciprocal of the forward PE versus the 10-year bond yield. And I kind of stumbled upon the Fed talking about this model in their monetary policy report. And I call it the Fed stock valuation model. And wouldn't you know it, just as I dubbed it that, it stopped working, as you as you can see here. But it was pretty close between the forward the forward earnings yield and the government bond yield, as you can see in this chart. This is another slice of misery and in inflation. Look, if PEs are determined by interest rates and inflation rates, then they're going to be hard to predict because both of those numbers are hard to predict over the next year, let alone over the 10 years. But I think what we need to consider is that what the market is predicting is how long will the expansion last, and the longer the expansion lasts, the higher the PE will be for the overall market, and the more for growth companies. So for fast growing companies, and this is what you can see in the Magnificent Seven. They account for now almost 30% of the S&P 500, but their earnings share has also increased. The revenue shares not as much, but obviously their profit margin has been very, very, very high. Let me move a little faster through these because I did want to get to this idea of growth is yeah, this is sort of it. This is the S&P 500 forward PE, so that's it again. And this time around, we added the long-term earnings growth, the analyst consensus long-term earnings growth expectations. And of course, when analysts are bullish on earnings growth for their economies, that's going to be reflected in the PE as it was here. And it could create a bubble situation to the extent that they get too confident. And the same thing happened over here. We're not quite as heady here, but relatively so. But our spin is that in our roaring 2020 scenario, this might actually be a realistic scenario for the market. And this shows productivity versus the long-term earnings growth expectations. Not a perfect correlation, but we see enough there to support our story. Obviously, that's one of the reasons we're showing it. But you can look at it on your own and conclude for yourself whether you agree with it or not. Eric, why don't you field some questions here? I got to just deal with the dog situation for 1 second here, so I'll turn off here and you go ahead and do the Q&A.
No problem. We have a couple in the queue. Feel free to send some more in. This first one's from Ian. Do you think it's counterintuitive where the big banks are touting plans to chase and hire more money managers, et cetera, if they also say public companies will have muted growth of 3% over the next decade? Yeah, to some extent, Goldman, came out with this sell side research. There's also a lot of pitches for alternatives these days. Private credit is a business that banks are also getting into and pitching. And if you say that public equity markets are overvalued and no longer an attractive proposition to get into, you can spend the myriad products you also have a little bit easier. And obviously those charge higher fees than, large cap index investing. Okay, same thing from Ian. So, yeah, I mean,
everything's good on my end, Eric.
Okay, yeah, we had a lighter queue. I think we stopped a little earlier than usual. But yeah, we can, here's one. So your positive assessment, this is from Willem, your positive assessment of future equity valuations assumes that the annual corporate earnings growth rate will be 6%. That is likely higher than the medium to long-term annual growth rate of future nominal GDP. He assumes that to be 4%, so 2% inflation, 2% real. Do you consider a persistent increase in the share of profits in GDP to be likely, economically or politically, or do you believe that future inflation and real GDP growth rates will be higher than his assumed 4% total?
Yeah, well, the 6% has been, somewhat volatile, but fairly consistent kind of return just for the index itself. And that in turn seems to be driven by the 6% growth rate of earnings. Um, I suppose, in our roaring 2020 scenario, we're expecting that the corporate profit margin continues to go up, and because of productivity and so on. And so we're thinking that while Goldman is kind of looking at not what could go wrong, but kind of once things are this good, they can't continue for another 10 years. Our view is, look, over the next 10 years, a lot can happen. You could certainly have a recession that'll depress earnings, but then it could make a big comeback. Eric, I was looking at the last decade from 2000 to 2010. The market was basically flat. Not the market wasn't flat, but from end to end point, it was
Mhm.
basically flat. But over that period, dividends quadrupled. So the market, was given no credit for the fact that companies just continue to earn money and continue to pay dividends. And I guess back then there was we had the recession and the tech wreck really in the early part of 2000s, and we had the terrible 9/11 event. And then, of course, 2006, 2007, 2008, well, 2007, 2008, and 9, we had the great financial crisis. And so there was the valuation multiple was held down by the perception that we're going to have a recession, and we did have a very wicked recession. This time around, we've had perceptions of a recession without a recession, and so the PE went down, but it only went down to 15, which is relative. A lot of the bears were saying bull markets don't start with a forward PE of 15, but that's what this one did, and now we're at 22. So yeah, I think by hook or by crook, I don't see any particular reason to believe that the future is going to be much different in terms of the 6% growth of earnings. And if anything, in our roaring 2020 scenario, it might be better.
Yeah, I mean, nominal growth is 5.5%, 6% right now, and if you think productivity growth is more like 2% instead of 1%, you add 1% labor force growth, you're at 3 on real, 2.5% inflation, you're at 5.5 nominal for a little bit longer.
Right.
So yeah,
And, and the more that economic growth is based on productivity, which is what we think,
mhm.
I think you'd want to pay a higher P for that rather than if it's based on inflation, because then inflation gets you the risk that the Fed will tighten and cause a recession. So why are you paying such a high PE?
Okay, good question. Next one from Peter. Can you please expand on the relationship between tariffs and the effect on US economic growth?
Well, every time, not every time, but on a regular basis, when Eric and I go around doing Zoom calls or meeting with accounts and we talk about the roaring 2020s, there are occasionally, people who point out, yeah, but that ended badly in 1929. Actually, it ended badly in June of 1930 when the Smoot-Hawley tariff was passed and the stock market was starting to anticipate that there might be that kind of tariff imposed, and the market was smart enough to know that that kind of draconian effect would be bad news. And so the market did take a dive in 29, but then it recovered half of what it lost. I mean, I think from May of 1930 going back to April of 1929, the market was basically flat. So it was no big deal. What was the big deal is when the Smoot-Hawley tariff was passed and then commodity prices collapsed, stock prices collapsed, and we had that was really the great crash. So um, there obviously is an analogy here. I mean, if Trump seriously slaps on 60% on China and 20% on the rest of the world and kind of sticks with it, I guess that could be depressing for the global economy. I mean, certainly would depress China, which is not in a good shape right now. What was that? Their industrial profits were down like 17%. I mean, it was pretty wicked. And of course, Europe's not doing too well. Germany's struggling with competition from Chinese-made autos. So that's kind of where we are in this whole situation. So there is a risk, but I guess let's see if Trump wins, and then let's see if that's what he does, and let's see. He is the art of the deal making. He wrote that book, The Art of the Deal, and so he is a deal maker. And I have to believe this is a negotiating position to get some more loosening up of the global trade system. Eric, you want to add anything to that?
Yeah, no, I think I agree with your last point. It could easily be universal tariffs for everyone without a bilateral deal with the US. And Scott Bessent, who's an advisor to Trump and obviously a successful hedge fund investor, wrote an op-ed recently in The Economist, which I think is helpful to get a gauge of like what a potential Trump 2.0 economic policy would look like. And it's obviously not it's not the same magnitude as what's being portrayed on the campaign trail. So,
Do we have any other questions? Take one more.
um, there's one question on small caps and emerging markets earnings growth accelerating faster than the S&P next year. So I guess we can take a quick one on small caps and EM.
Well, that's been the problem really for small cap is there has been no earnings growth. It's been kind of in a coma, just a flatlining. And we keep watching that on a weekly basis. We look at forward earnings. We're kind of getting, what are the analysts seeing? And the analysts aren't really seeing anything picking up. And this is for the S&P 600. And a lot of these companies actually earn money, whereas in the Russell 2000, a significant percentage is losing money. So we would stay light on the S&P 600. Maybe look for opportunities in the 400, the mid caps. Stay light on the Russell 2000. I think they need interest rates to fall, and we've been pointing out that this time we didn't have a credit crisis that led to a credit crunch that led to a recession. So the Fed isn't going to do what it did in the past, and that is drop interest rates dramatically. And without that, I'm not sure that the smaller caps do well, but the market should continue to broaden, we think, from the Magnificent Seven to the S&P 493. Well, with that, Eric, thanks as always for joining me. Thank you all for joining us. We appreciate the great turnouts we get from all of you, and we'll keep in touch. And I guess we'll see you right before the next elections. Thank you.
Have a good week, everyone.